Welcome to Multifamily Loan Talk, the show where we teach you how to use other people's money, i.e. the lender's money, to finance your multifamily deals. On today's episode, we are reviewing another Freddie Mac product. This product that we're reviewing today is the Freddie Mac Conventional product. With that being said, let's go ahead and get right into the show. Today we have the Freddie Mac fixed rate loan product. This product is a very flexible product, and you can use it for many different things or many different properties within the multifamily space, as we will see today. So let's go ahead and dive right into the product and look at what we're working with today. So as you can see right here, the product snapshot. This is the Freddie Mac fixed rate loan. This product snapshot basically says that this loan can generally be used anywhere for projects that's anywhere from $5 million to $100 million. However, larger and smaller deals are considered on a deal by deal basis. Who can borrow? You can borrow with a limited partnership, corporation, limited liability company, or a tenant in common. If you have a loan greater than $5 million, borrower must be a special purpose entity, which means also known as SPE. So if your loan is more than $5 million, you have to open up a SPE. If your loan is under $5 million, you may be able to borrow under a single asset entity, and they do support eligible mixed use properties. So with this, as you can see right here, with this fixed rate loan, you're able to get flexible, streamlined financing solutions with certainty of execution. And you can use this for acquisition or refinance of multifamily housing. And that's pretty much straightforward. So let's dive into the meat and potatoes of this loan product. So as we can see right here, who can borrow? They do a good job at telling you who can borrow just right off the bat. So who can borrow? So these are the eligible borrowers. You can borrow if you're a limited partnership. You can borrow if you're a corporation. You can borrow if you're a limited liability company or a tenant in common with fewer than 10 tenants in common. You can borrow if you're a general partnership, limited liability partnerships, REITs, and certain trusts may also be acceptable in limited circumstances, and they're subject to additional requirements. And the borrower must, so we can see right here, the borrower must usually be a SPE, which is also known as a single purpose entity. And however, on loans less than $5 million, upon the borrower's request, a borrower other than a tenant in common may be a single asset entity instead of a single purpose entity. If the borrower is structured as a TIC, also known as a TIC, each tenant in common must be an SPE. So they're telling you straightforward. So if you have a tenant in common structure, each person within that TIC must have an SPE for this deal. Now, let's go to eligible properties. So what type of property can you buy with this Freddie Mac's fixed rate loan product? So you can buy standard multifamily housing. You can buy student housing. You can buy senior housing, manufactured housing communities, cooperative housing, and targeted affordable housing cash. You can also, and the loans may also be used for acquisition or refinance. So let's look at the terms. How long can you use this loan for? So the terms are generally 5 to 10 year terms, and you can have up to 30 years if loan is not purchased for securitization. And securitization is basically when a lender or when a lender takes the loans, package them up in different tranches, and then sells them to investors so that investors can collect money on it. That's the simplest way to explain what securitization is. So just think of it as your loan comes in, and they rank these loans according to risk, and they put them in different packages. And if you want a low risk package, then you'll get low interest rate, but it'll be low risk. If you want high risk loans, and that means you're going to get a high risk package, but your interest rate is going to be a little bit higher, meaning that the coupon investors collect will be higher, then they put them in that package. And they just package these deals up, take them to the market, and sell those packages to investors. So think about it as going to the supermarket and how the and how the butcher in the back comes out. I mean, butchers in the back cut up the meat, put them in the packaging, and then you as the buyer come to the store, look at the packaging and say, I think I want this, this, and this. That's the same thing they do with the loans. Okay, so we got that amount. We talked about this earlier. The general loan amount is between 5 million to 100 million, and it may be larger and smaller loans may be considered. So larger loans and smaller loans may be considered on this deal or with this product. Maximum amortization is 30 years, and this is the amortization's calculations. So they do either an actual divided by 360, or that, which is the standard calculation, or they do the 30 divided by 360. That's also available, which is basically the days over 360, but we're not going to get into that. So let's look at our lockout period. So you have a lockout period of 2 years following securitization. So what does this mean? This means that for 2 years you will not be able to refinance this loan at all. So you're locked into this loan for a minimum of 2 years. So let's look at our prepayment penalties. So after that 2-year lockout period, we can see right here, yield maintenance until securitized, followed by a 2-year lockout, and then defeasance thereafter. Defeasance is a big word for prepayment penalty. And so there is no prepayment premium for the final 90 days of the loan. But if the loan is not securitized within the first year, then yield maintenance still applies until the final 90 days. Meaning that you have to hit a certain, the bank or Freddie Mac, the lender in this case, has to hit a certain yield in order for you not to be in technical default. And we're not going to get into that either. But yield maintenance without defeasance. So basically you're locked into this loan for 2 years. Your prepayment penalties. So until you have yield maintenance, meaning that you have to the loan must hit a certain yield until the 2-year lockout period. Once the 2-year lockout period is up, then you have defeasance. And defeasance is basically your prepayment penalty before you start to, get out of it. And your prepayment penalties is normally the step down of 5, 3, 2, 1, and then no prepayment penalty. So that's that. Tax and insurance generally require replacement reserve deposit. It's generally require recourse requirements. So this is a non-recourse loan except for standard carve-out provisions. All right, let's look at this. So we have our supplemental loan availability. Supplemental loan availability. So this is available. So you have access to a supplemental loan. And most people use supplemental loans when they have long-term financing and they need to increase the value of the property or do some type of work to the property. Then they go out and take a supplemental loan and then use that as like a bridge loan or something like that to fix up the property. And once they fix it back up, then they either sell it or they pay off their supplemental loan. So that's that. Now let's look at our application fee. So this loan does have an application fee. Greater of $2,000 or 1% of the loan amount for conventional first mortgages and senior housing loans. For conventional first mortgages. So when you apply for this loan, it's either going to be $2,000 for an application fee or 1% of 0.1% of the loan amount. Meaning that if 0.1% is greater than $2,000, then your application fee is going to be the higher of the two. So senior housing loans, we can see right here, senior housing loans are greater than 5,000 or 0.15. But we're not focused on senior housing. Supplemental loans, we're not focused on that. All right, so if you're doing multifamily and using conventional first mortgage, then you can expect your application fee to be $2,000 or 0.1% of the loan amount. If you're doing targeted if you're targeting affordable housing products, then you can expect your application fee to be $3,000 or 0.1% of the loan amount. Okay, we got that. All right, so let's look at our early rate lock option. So sometimes you can lock in your rate at application, and sometimes you can lock in your rates early. In this case, they're telling you exactly what it is here. So early rate lock option available for varying durations, typically ranging from 60 to 120 days until Freddie Mac purchases. Index lock option is also available, and you should consult with Freddie Mac and everybody else to determine your eligibility. So you can lock in your rate, but you must talk to a representative to determine the eligibility of you locking in this rate. So let's move over to our refinance test. So no refinance test is necessary if the loan has an amortizing debt coverage ratio of 1.40 or greater and a loan to value of less than 60%. So basically what this means is when you're doing a loan, the underwriter puts a loan through what they call a refinance test, meaning that for the period of a loan, they're going to look at if you refinance within, this many years, how much are they going to make on it, and will the property itself be able to pay off the loan that's currently on it. And so they're saying basically here that you don't have to do a refinance test, or you don't have to meet a refinance, stipulation if you have a debt service coverage ratio of 1.40 and you have a loan to value of 60% or less. Now, let's look at our fixed rate maximum LTVs and minimum DSCRs. So if you have a loan that's greater than 5 years and less than 7 years, then your amortization, or it must be set, you can go up to 75% LTV, and you must have a 1.3 times debt service coverage ratio if it's amortizing. Now, if you have partially interest only, you must have 75% and 1.30 debt service coverage ratio. And if it's full term interest only, then you must have 65% LTV and 1.40 debt service coverage ratio. Now, how about if your loan term is 7 years? If it's 7 years and it's amortizing, then you have to have 80% LTV, or you can go up to 80% LTV and have a 1.25 debt service coverage ratio. And then partial is the same thing, but if you go full term interest only, you can see right here that you can go up to 70% LTV and 1.35 DSCR. And then if your loan is greater than 7 years and it's amortizing, then you can have 80% LTV and 1.25 DSCR. And then it's the same for full term interest only. It's the same as the 7-year term. And so that is it for the Freddie Mac fixed rate loan product. As we can see right here, with this particular loan product, you can use it if you're doing a multifamily deal, a senior housing deal, a student housing deal, a mobile home park deal, and an affordable housing deal. We know that you can use this loan if you need a loan anywhere from 5 to 100 million, and you can use this loan if you're borrowing as a LLC, a corporation, a REIT, a TIC, and you can even borrow under a single asset entity. So if you're looking for financing for your next multifamily deal, don't hesitate to reach out and see what options you have available. I have a link somewhere in my bio. Just click the link, hop on my calendar, and let's talk. Make sure you leave a review, make sure you like, and make sure you subscribe.